Hello and welcome. The BSE Sensex touched 50,000 points a little while ago, a move that's quite dramatic given that it has risen almost 90% or more than 90% since March 2020, where it was down at somewhere near 25,000 something or a little under 26,000. So a more than 90% jump is of course dramatic, but this also usually compels, incentivizes and tempts people to jump into the stock markets, perhaps at the wrong time. Very few do it at the right time and obviously end up making some mistakes. So here today in Investment Mantras, as we talk about investing in the context of safe investing, we try and understand what should you do and what should your philosophy of investment be, and let's learn from someone who's obviously been a veteran investor in the stock markets and who's followed a consistent philosophy and written many bestseller books about it. I'm pleased to be joined by Saurabh Mukherjea of Marcellus Investment Advisors. Saurabh, thank you very much for joining us.
My pleasure, Govind. Great to be here.
Right. So, the questions I'm asking you today could be asked at any point, but they always acquire a little more importance or relevance when the markets are zooming as they have been in recent times. And when, as it's happened before, when there are new highs hit, people get more tempted as more people move in, and obviously mistakes also tend to be made. So if I were to ask you firstly, what should be a philosophy of investment? I mean, firstly, the very basic philosophy of investment, at least as you've learned it over the years, what would it be?
So look, I've been living in India now for 12 years. I've had a great time investing in Indian markets, learning about the country. And what we have learned in India is that the main thing to be very careful about is accounting fraud. Right? In our country, accounting standards amongst listed companies are fairly mediocre, and especially in times like this, I think you've captured the euphoria of the current times very well. It's really, really important that investors are circumspect about the sorts of companies they invest in. Our experience in Marcellus suggests that 70-80% of listed companies have highly suspect accounts. Many of those companies had a stellar run in terms of their share prices zooming up in the last 8-9 months. And therefore, I'm really, really worried that many of the viewers of this program will be putting their lives hard-earned savings in these companies with shoddy accounting. So the first thing we try to do is weed out these naughty promoters, as I call them. The second thing to do in India is we are still a relatively poor country. I think a couple of weeks back, the United Nations published its Human Development Index. You can see we're amongst the poorest fifth of the world's countries. Therefore, in India, what we have found is one should invest in companies providing the basic essentials of life to India's 1.4 billion people, right? So, baby milk powder, chappals, undergarments, painkillers, blood tests, basic retail banking service, right? So, clean promoters, essential products and services. And the third thing, and this is unique to India, third thing, invest in monopolists. Our country is now the most monopolized amongst the world's large economies. And the beauty about our country, which I'm sure many of your viewers will appreciate, pretty much any product or service which is essential in our country, one or two companies will take home 90% of the profits. So if you look for monopolists selling essential products and services and with clean accounting, what you end up getting in India, broadly speaking, is around 20% compounding in your portfolio. This is a fairly stable outcome. These sorts of companies tend to be stable, robust companies who compound your wealth steadily. Whether the Sensex is booming or the Sensex is not booming actually becomes quite irrelevant for these companies.
Right. So let's talk about monopolists and essentials of life in a moment. But let's start with the more complex, or I would think the more complex part, which is clean accounting. Now, how does an investor, and I'm sure one of the things that people have felt, at least in recent times, is the temptation to go and invest directly in stocks as opposed to investing in mutual funds, because clearly stocks seem to have moved and zoomed much faster. So how does one begin to identify companies whose balance sheets or whose accounting is not as good as it should be?
Right. So I remember it was around 5 years ago, Govind, you hosted me on Boom Live about on my book Unusual Billionaires. So thanks to your viewers, the book went on to become one of the biggest selling investment books ever written in India. Chapter 10 of Unusual Billionaires, Chapter 10 of my 2016 book Unusual Billionaires explains the 10 accounting ratios that I use to identify accounting issues, accounting fraud. So, for example, a simple accounting ratio, which gives away a lot of naughtiness, is you look at the growth in auditors' fees. Every company reports in its annual report what fees it's paying the auditor. And if you take, say, 5, 6, 7 years of annual reports, and you see that consistently the auditors' fees are growing faster than the company's revenues, it's almost inevitable that that sort of company is basically incentivizing the auditor to do naughty things, and you should therefore stay away from such a company, right? Just to cite another accounting test given in Chapter 10 of Unusual Millionaires, you look at the operating profits that the company is declaring. That's given on the face of the P&L. You compare that number to the operating cash flow, which is on the financial statements. If operating profits divided by operating cash flow, if the ratio is below 70%, you need to be very, very careful with your money. Right? Most decent companies in India will have an operating profit to operating cash flow ratio of at least 70%, typically of 80%. Right? So there's 10 such simple ratios that I've given in Chapter 10 of Unusual Millionaires. And to be honest, if you can't apply those ratios, I'd be very circumspect about investing directly in the Indian stock market. You're better off going through a fund manager.
But of the 10 that you mentioned, and I'm not going to ask you to mention all 10, and this obviously is a hint, nudge, nudge signal to everyone watching to go and get Saurabh's book. But which would you categorize as the most important, or at least the 2 or 3 which are the most important ratios?
Yeah. So I think if you ask me, my favorite ratio, the one that we found to be sort of the Brahmastra of accounting, if you ask me, is operating cash flow divided by operating cash flow divided by operating profit. The ratio of cash flow to profit, if that ratio isn't 70-80%, you really are playing with fire. I think the second ratio we love to look at is the asset turns of a company, right? So in any industry, an asset turn measures how many times the fixed asset, the machines of the company are being sweated to generate revenues. If you don't see 2 times asset turns, you should be a little circumspect. The third ratio we discussed, simple ratio, but incredibly powerful, growth in auditors' fees divided by growth in revenues. If that ratio is near 1, you really are in very dicey territory. So look for, see, operating cash flow to operating profit, at least 70%, ideally 80%. Look for asset turns approaching 2, and look for accounting fees growing much slower than revenues. The auditors' fees growing much slower than revenues.
Right.
3 straightforward ratios.
Right. And can you illustrate that for us, the operating flow versus operating profit ratio,
Well,
Saurabh?
let me do a positive example. The negative example, perhaps we could do a separate session on forensic accounting. So
Sure.
if you take well-run pharma companies, right? And I'll name 2 pharma companies, both of which are in our portfolio. If you take well-run pharma companies like Abbott Labs or Divi's Labs, their ratio of operating cash flow to operating profits, their ratio will be pushing 80%, actually pushing 100%. Right? So for them, cash flow and profits are almost at parity, right? Which is outstanding. Even if a company is at 80%, I think that's a good result, right? Similarly, if you see these companies, their auditors' fees will not be growing faster than, say, 5-10%. The revenues are growing at double that, right? So the auditors' fees are growing much slower than their revenues, which is the way it should be. And asset turns for these companies will be very, very impressive. They'll be generating many multiples of actually 2 times, right? So 2 simple pharma companies. Obviously, there are other naughty pharma companies, large pharma companies who do poorly on these metrics.
And why is that? I mean, so why does that happen, and what is it revealing or concealing?
Right. So straightforward thing, right? Why does any company in any industry do naughty things, right? Going back all the way to 2008 and to Satyam, typically promoters flatter their revenues. By flattering the revenues, they flatter their profits. By flattering profits, they boost the net worth of the company. Once you boost the net worth of the company, you can borrow more money from the banks. And what's very common in India is to then pilfer this cash borrowed from the banks, pilfer it through related party transactions or shady transactions, and then to use it for personal investments of the promoter. This is a very common template in our country, right? Overstate revenues, overstate profits, flatter the net worth, borrow more money from the banks than the banks would have given you otherwise, and then take the money and run. And we've seen, that's a sort of time-tested Indian stratagem, and one needs to therefore watch out for it using financial forensic accounting parameters such as the ones we've discussed.
Right. And, when suppose, let's say, for instance, there are exigencies, things are going wrong. So does this ratio account for that? A sudden dip in the fortunes of a company or an industry?
So just to be clear, these ratios that we've discussed are financial hygiene ratios. They are telling you whether the company is cheating or not. So this is telling whether the company is honest or not. Just because the company is honest doesn't mean you'll make a lot of money, right? But what you're sure about is that the company is not going to melt down overnight in a Satyam type affair where 90% of the market cap melts in a few days, right? So the first set of tests that we do, the forensic tests, are to assess the trustworthiness of the promoter. The essentiality piece I was highlighting is on the robustness of the underlying demand. So one of the reasons, when I spoke to you, perhaps it was 5 or 6 months ago on a similar program, right? One of the reasons I was so optimistic about investing, and we were so optimistic in telling our clients to invest, was we could see through COVID that demand for essential products like baby milk powder, like footwear, like paints held up quite nicely, right? For obvious reasons, people continued living their lives in spite of COVID. And furthermore, because we are invested in powerful monopolists, these monopolists actually gobbled up even more market share, because in COVID, the weaker companies got pulverized, right? And I think I remember I discussed an example with you of how across the world, COVID is transferring market share from the weak companies to the strong companies, ironically resulting in the strong companies growing faster courtesy COVID than they would have grown otherwise, right? So that dynamic has played out beautifully. I think just yesterday, Asian Paints announced their results. They grew volumes at 30%. Now, clearly, the paint industry's volumes aren't growing at 30%. Therefore, Asian Paints is gobbling up market share. Disclosure, it's a big holding for us. Similarly, HDFC Bank announced results, I think, last Saturday. Their loan book is growing at 17%. As the RBI is pointing out, the banking sector is not even growing at 1/5 of that rate. Right? Therefore, HDFC Bank is gobbling up market share. So this dynamic, clean companies, essential products and services, monopoly franchises, powerful franchises with deep competitive advantages, is incredibly powerful in India. It allows you to grow as the economy recovers from COVID, and it allows you to build a steady, strong, robust portfolio regardless of the vagaries of the Sensex.
Right, and this is a very, very good, important, and powerful starting point or platform from which you could go to the next level. And the next level would be, do you buy now? And if so, how? Or how do you ensure that you're not buying at the top of the market? And even if it is the top of the market, is that a bad thing?
Right. So nobody can time the market. We can't time the market, and anybody who comes on your show and claims to time the market, I think you should point them towards the asylum, right? Because it is inconceivable that anybody can time the market. You can't do it, right? So what should one do, right? First off, you give your money, you invest your money with promoters who you know are clean. Second off, you invest in products and services whose demand is broadly invariant over time. And thirdly, you invest in companies who are gobbling up market share. These three things give you profit compounding, EPS compounding at the 20% mark on a reasonably consistent basis. Now, why is that a big deal? The return from any stock can be broken into two parts: the change in the PE multiple and the earnings growth. Let's take a disaster scenario, Govind, that over the next decade, PE multiples halve on all stocks in India and the broader Indian market. That means the PE multiple will deliver minus 7% at the stock level, right? Every single year, anything which falls at 7% per annum halves in 10 years, right? If the earnings compounding of our companies is 20%, our return on that portfolio will be 20 minus 7, 13%, right? So we're still going to make a reasonable return in spite of the PE multiple halving, were it to come to that. The challenge I have, the worry I have is at the Sensex level or the Nifty level, right? Over the last 10 years, share prices have compounded at 8-9%, but earnings compounding has been zero. This is a 10-year story. This is not just COVID. 10 years, earnings compounding at the Nifty and Sensex level has been close to zero, but the share price compounding has been 8-9%, right? Which means the PE has zoomed up. Now, if the Nifty's P, let's take Nifty as an example, could be Sensex as well. If that P halves over the next decade, that's minus 7% of the P halving, the earnings compounding is weak. Even if it's 5, 6%, my worry is the typical stock market investor could end up with very little to show for a decade hence. Now, what I'm talking about is not just theoretical. This has happened before.
Right.
93 to 03, the broader Indian markets gave very little return. The sorts of companies we are investing in, Asian Paints or Pidilite or HDFC Bank, the sorts of companies we are investing in gave 13, 14% returns, right? And therefore, the point I'm trying to emphasize is I can't time the market. I don't think anybody can. What we can all do is invest in clean, well-run, dominant franchises. By doing so, we protect ourselves from a market correction, even if the market correction is prolonged.
Right, and a couple more questions, Saurabh. So, for this is the company view, and you're right. There are companies who are doing well. There are founders, promoters, professional CEOs who are doing a good job and will work hard to protect their stakeholders and their shareholders' interests. But the economy as a whole might not decide to, or might want to move in a different direction, as it happened for wholly inadvertent reasons in 2020. Now, how does one protect one's investment at times like this? Or can one even do that?
So just to be clear, folks, there is no link between the economy and stock level investing. I think this is one of the biggest sort of myths that if I opine on the economy, right, and we don't have any shortage of people in our country, people sitting in America, people sitting in London, people sitting in Mumbai. It's like the Indian cricket team. Everybody has a view on what the captain should be doing, and I'm just as interested in those views as anybody else. But you're not going to make any money. Nobody's going to make any money forecasting GDP growth in India, right? Last I knew, there were no prizes being doled out for forecasting GDP growth, whether it was going up or down. All I can do is make money from investing in companies, right? And since I've just explained in the last 5 minutes, I've given you two examples of giant, well-run companies who are gobbling up market share, even if the economy were to go south, right? Yeah, my reckoning is the economy's already started growing. Even if the economy were to go south, the company who gobbles up market share is still going to grow. So I would rather spend my time, and I would rather request your viewers to spend their time focusing on companies who are dominating essential products and services, rather than breastbeating about the latest GDP growth forecast, right? For what it is worth. One very interesting thing, right? And it gives you a sense of how anchored we get. This whole paradigm of forecasting GDP growth and then trying to figure out whether the stock market makes money or not comes from the Western context. It works in homogeneous, stable, mature Western economies. Our country is neither homogeneous nor is it mature. We're still an underdeveloped economy, incredibly diverse, incredibly heterogeneous. So unless you're completely bonkers, you're not going to take a GDP growth forecast and use that to drive your investment view in India, because India is 5 or 6 economies packed into one, and there really is no one economic growth rate. What's happening in Mumbai has no relevance to what's happening in Kolkata. What's happening in Kolkata has no relevance to what's happening in Bangalore. So this Western paradigm of forecasting GDP growth rate, say for the UK, and using that to figure out what is my equity allocation in the UK, it works in stable, mature, slow-growing Western democracies. Unfortunately, it doesn't work in our country, but nobody seems to have told a lot of people in our country that. So they spend a lot of time agonizing and tearing their hair out about GDP growth forecasts.
Right, and it would also therefore mean that the micro infrastructure in India, which supports the capital market ecosystem, is also in reliable, safe, and good shape. So, assuming you would ignore all the macro part, including the economy, macro economy, as you mentioned, but the micro fundamentals and the micro infrastructure or the ecosystem is definitely.
Let's look at the micro. Let's look at the micro in the sense that let's look at what's broadly happened to micro, right? Our road networks have broadly, I think, doubled in the last 15 years or so. A decade back or 12 years back, there were, I think, 2 or 3 million broadband connections. Now there are 400 million broadband connections. Famously, as I think every child knows, a decade back, there were less than 500 million phone connections. Today, we have 1.4 billion phone connections. Airline passenger traffic has grown at 15 to 20% per annum, which means it's pentupled in the last decade, right? GST has had a benefit of integrating the economy. The point I'm driving at is, if you want to look at micro, look at these sorts of micro changes, the connectivity of the country, the coming together of a disparate economy, and thus the ability, and this is quite important, thus the ability of the local monopolist, the company which was hitherto operating on a local scale and doing well, to now spread his wings on a national scale. Right, the increasing connectivity of the country has broadened the canvas for
Right.
efficient, well-run companies who are now able to spread their wings and dominate on a national basis. If anybody wants to understand how this plays out, America went through this process from 1880 to 1930. Those days it took them far longer. 1880, the railroads came to America. 1890s, the telegraph came. 1910, the car and the road network came. And in those 50 years, America got networked. The result of that was the demise of small, local, village-oriented companies, regional companies, and the rise of giant monopolies like Standard Oil, like Heinz, like Kellogg's, like Pillsbury's, right, like Wrigley's. Almost all the modern American brands were born in that 50-year period. So it's not as if in 1879 Americans were not having ketchup. It's just that the ketchup manufacturer was a small Joe Schmo regional player. Heinz was the most efficient ketchup manufacturer. He consolidated the ketchup industry and created a giant franchise, and his shareholders, their shareholders benefited. The same dynamic is playing out in front of our eyes in India. It's just that what took 50 years there is happening, I reckon, in 20, 30 years. And we're probably at the 30, 40% stage of that. I think we're probably a decade into that rapid sort of assimilation of the economy. We've probably got 15, 20 years more to go.
Right, and the very powerful insight, Saurabh. The last question to you. Despite the principles that you've laid out for yourself, which I'm sure you followed very consciously, you must have made some mistakes. And what would you have learned from that? And what would you share with us?
Yeah, so I think the mistake we made was, and I think this. I'm glad I spent a decade working in India before we started managing the monies of others. When I was early on in my Indian stint, in my Indian career, right, we used to see fast-growing companies, and because of my sort of Western training, I used to assume that because they're growing fast, they must be doing something dodgy or shoddy, right? So, example, Bajaj Finance, under the current management, Bajaj Finance started growing from 2008 onwards, right? So even in 2012, 2013, 2014, we would go to their showrooms and we would see that they were growing like a weed, that 70, 80% of consumer durable financing for washing machines and fridges was Bajaj Finance. And my sort of, my ignorance was such that I thought this was a dodgy operation, because I was asking myself, how can you possibly be lending so much money to people who are buying fridges and washing machines, right? And it took us another 3-4 years to realize how they were doing it, and the amount of big data they were using to diligence, using technology, they were diligencing customers before the customer had even put the request. It's quite brilliant, actually, right? So when you go to a Chroma or a Vijay sales and you say that I want my fridge financed, all that the Bajaj Finance desk there needs is Govind's PAN number and his address. And in 2 minutes, they know exactly what to do with you, because they've already built their intelligence and their credit profile of Govind. Right? I didn't know this, and I mistakenly concluded 4 years ago that 5 years ago that Bajaj Finance was a mistake to invest in. Thankfully, 3 years ago, my colleagues educated me otherwise, and even better, January, February, March, when people panicked and sold Bajaj Finance, when it fell 70%. My colleagues at Marcellus had the presence of mind to triple our position in Bajaj Finance.
Right. So that's a mistake in a positive way. What's the mistake in a negative way?
So I think we all get enamored by our own constructs, right? So the construct I gave you, clean company, essential product, dominant monopoly, that applies perfectly to ITC, right? It is, as everybody knows, a dominant company in the cigarette industry, incredible free cash flows, and we were ITC shareholders till 8-9 months ago. And we were enamored by our own construct, right? And ITC is a powerful company, very successful company. But what we've I think forgotten a little bit was, why is it that we want dominant franchises? Because dominant franchises generate massive amounts of cash flow, which they reinvest to fuel the growth engine. right? In ITC's case, they were the cash has got bulked up on the balance sheet. They have 40,000, 40,000 crore of cash, and the reinvestment cycle wasn't quite fructifying, and perhaps we should have latched onto it quicker. Anyway, after a year of deliberations, discussions, analysis, discussing the matter with management, we finally decided in July of 2020, in July of 2020 to check out of ITC. It remains a powerhouse franchise. It's done a very effective job of building a big FMCG business. I think probably after Unilever, they're probably one of the largest. I think after Unilever, they probably are the largest FMCG business in India today. But the accumulation of cash on the balance sheet, we should have perhaps been more circumspect about a little earlier, because the whole point of dominant franchises is that they return the money or reinvest the money. And I think had we been a little bit more circumspect, perhaps we would have checked out of ITC. Our reckoning is ITC will continue to be a solid compounder in perhaps the 15% mark, which is remarkable in India. 15% compounding in India is something that most people struggle to achieve. But our goal has always been to get our clients to 20% compounding. And I think had we been a little bit more focused on our goal than on our intellectual frameworks, maybe we would have done better.
Saurabh, thank you so much. That was most candid. Thank you for sharing your lessons, insights, and of course, the construct that I'm sure is going to take those who are watching this to something much better than what perhaps they've been doing so far. Thank you once again for joining us.
Thank you, Govind. Thanks for hosting me.